Hey there, future financial geniuses. Welcome back to the channel. Today, we're going to break down something that sounds like a fancy math class, but is actually one of the easiest and most powerful ways to grow your wealth. Yep, I'm talking about dividend reinvestment, dollar cost averaging, and compounding interest. I know it sounds like a lot of buzzwords, right? But don't worry, I'll make it as easy as stealing candy from a baby, just don't actually steal candy from babies. So, if you're ready to turn your pennies into dollars, stick around. By the end of this video, you'll understand how these three financial concepts work together like the Avengers of investing. But without the superhero costumes, unfortunately. Let's get into it. First up, let's talk about dividend reinvestment, or as I like to call it, the gift that keeps on giving. When you invest in dividend-paying stocks, those companies send you a little thank you note in the form of cash dividends. This might sound like a nice bonus, right? But instead of taking that cash and treating yourself to a fancy latte, you can reinvest those dividends into buying even more shares of the same company. Here's the magic part. When you reinvest those dividends, you're buying more shares, which means next time you get a dividend, it's even bigger because you own more stock. It's like planting a seed and growing a tree that keeps giving you more seeds. It's a beautiful thing. Next up, we've got dollar cost averaging, or DCA, which, let me tell you, sounds a lot fancier than it actually is. All it really means is that you invest a fixed amount of money into an asset, like a stock, ETF or mutual fund, on a regular schedule, no matter what the market is doing. It doesn't matter if the market's going up or down, you're sticking to your plan and investing that same amount every time. So why does this work? Well, DCA helps you avoid trying to time the market. If you invested all your money at once and the market took a nosedive, you'd be bummed. But with DCA, you're buying in at different price points. Sometimes you're buying when the market is lower, and sometimes you're buying when it's higher. But over time, it averages out, and you're less likely to overpay. See, when the market goes up, you buy fewer shares, and when the market goes down, you buy more. This helps smooth out the bumps, and in the long run, you're paying a fairer average price for your investments. All right, here comes the fun part. Compound interest. This is where the real magic happens. Compound interest is the idea that not only are you earning interest on your initial investment, but you're also earning interest on the interest you've already earned. It's like a snowball rolling down a hill, getting bigger and faster as it goes. Imagine you invest $100 and it earns 5% interest in a year. After that year, you've got $105. But the next year, you don't just earn 5% on 100. You earn it on the $105. And the year after that, you're earning interest on 110. 25 times. And so on. It's like your money is doing push-ups while you're taking a nap. So, let's put all these concepts together. Ready for the big picture? Here's how they work in harmony. You're investing a fixed amount of money regularly. That's dollar cost averaging. And you're using those dividends to buy more shares. That's dividend reinvestment. But here's the kicker. Over time, your dividends and your new shares keep earning interest, which then earns more interest. That's compound interest working its magic. It's a powerful cycle. By regularly reinvesting your dividends, you're increasing the number of shares you own, and that means more dividends to reinvest. More dividends mean more shares, and those shares keep earning compound interest. It's like a financial snowball, and who doesn't want a snowball that grows into a money avalanche? Okay, I may have gotten carried away with the avalanche metaphor, but you get the point. This cycle, if done consistently over time, can lead to exponential growth in your portfolio. It's slow at first, but the longer you stick with it, the faster it grows. Like a little acorn turning into an oak tree. All right, let's break this down with some real numbers so you can see how it works. Let's say you invest $500 a month into an index fund that pays a 4% dividend yield, and you're reinvesting those dividends. Over the course of 30 years, let's see how that plays out. After 30 years, you've invested $180,000. But thanks to DCA, your money is spread across different market cycles. And thanks to dividend reinvestment and compounding, your portfolio has grown to over $550,000. That's the power of consistent investing, reinvesting dividends, and compounding interest. You put in $180,000, and over the course of 30 years, your money has nearly tripled, all without you needing to do much. Just stick to the plan and let time and a little bit of magic do the heavy lifting. Now, before you get too excited and start running out to invest all your money, here's the key takeaway. Patience. None of this works overnight. In fact, you'll probably feel like you're not seeing results for the first few years. But over time, those dividends add up and the compound interest starts to kick in. Think of it like planting a tree. At first, it's just a tiny seed. You water it, nurture it, and wait. But eventually, that tree grows tall and strong. Same with investing. You plant the seed, and over time, it grows into a financial tree that gives you fruit for years to come. So, let's recap. Dollar cost averaging helps you avoid the pain of market timing. Dividend reinvestment supercharges your stock purchases with those sweet, sweet dividends. And compound interest makes everything grow faster than you could ever imagine. Put them all together and you've got a winning strategy for building wealth over time. If you enjoyed this video, don't forget to hit that like button, subscribe for more personal finance tips, share and leave a comment below telling me your favorite investment strategy. I'll see you in the next video, where we'll talk about how to make your money work harder than your gym routine. Trust me, it's way easier.